All right, so in this video, what we're going to talk about is the three main things that we're looking at when we're qualifying a client. A lot of times when you're calling clients on the phone with internet leads that we have, sometimes the conversation is going to go about qualifying and things like that. So I want you to know the main things that we're looking at when we're qualifying a person. Okay, and the main things we're looking at are credit, debt to income ratio, and then assets. And sorry, I'm at my house. You may see my son, hear my son in the background yelling at Fortnite. But so credit score, okay? Now this is always changing, but typically we need at least a 580 credit score to make anything work, okay? Conventional, you need a 620 credit score. Down payment assistance, you need a 640 credit score. And you know, if you go less than 620, it's possible, but usually we can't make it work. Now, one of the things that's important is even if a client's credit score is lower than where we think we need it, we still want to pull their credit so we can put them either in our free credit optimization, which is credit tool, where we have credit optimization experts that give them a plan to get their credit score to a certain level. We also have what we call what if scenarios and rapid rescore. What if scenario is something like this. Let's say your credit score is 625 and I need to get to you to 640. Okay, I can run scenarios on you paying down certain accounts to get you to 640. Now, it doesn't always work, but it's a pretty good solution if you're pretty close to where we need you to be. We can run a scenario and say, let's just say we say, hey, this Chase card that you have $2,000 on, if you pay it down to 500, your credit score will pop to 640. Okay, then we ask the client to do that, and if they do it and can show us proof, we can rapid rescore the credit in 3 to 5 business days. Which if you do that organically, it usually takes 2 to 3 months. So a huge difference there. So credit score is something we're gonna look at. The second thing, and this is probably the main thing that doesn't, that people have a hard time qualifying for, is what we call debt to income ratio. Okay, in debt to income ratios, we're gonna look at your total monthly income versus your total monthly expenses, and we calculate a ratio off of it. Okay, now your monthly income is before taxes are taken out. So if you're a W-2 borrower and you make, I don't know, 50,000 per year, we're gonna go off that, not what you really take home. If you're self-employed, what we're gonna do is, if you're self-employed, you have a revenue, and then you claim a lot of expenses, and then you claim a profit. Okay, we're gonna go off 2 years average of your profit in most cases. Sometimes you can use 1 year. And then we can add back a few things in, like depreciation of assets and some business mileage. But what a debt to income ratio does is, let's give you a real simple example. Let's say you make $1,000 per month gross. Okay, we need all your bills on your credit report to be $500 or less, including the new mortgage we're qualifying you for. Okay, so this is a really low one, but I'm just using those numbers. Okay, so if $500, if all your bills are $500 and you make $1,000, your debt to income ratio is 50%, because 50% of your income is going towards debts on your credit report. Now, here's what's on your credit report. We're doing the new mortgage, taxes, and insurance, and HOA. Okay, it would be credit cards, auto loans, student loans, things like that. It's not food, entertainment, expenses, anything like that. It has nothing to do with it. Okay, it's just things that would be on your credit report. We also have to include child support and alimony if that's the situation. Okay, the last thing is assets. Now, what assets are for, there's a couple of different products that require what we call cash reserves, but assets mainly mean if you're putting a certain amount of money down to buy a house, we have to show that you have that, or you have to give a gift from a family member to get it. So, for example, if we qualified you for a loan and you need to put $10,000 down, we have to show that you have those in a bank statement or a liquid asset, or show how you're gonna get those. Okay, now sometimes what you can do, and this happens a lot with first-time home buyers, is let's just say you have $5,000 in your bank account, but you needed $10,000 to do the pre-qualification that we have put together for you. You may call your parents and say, hey, can you guys give me $5,000? And what we would have them do is write a gift letter, and a gift letter says, I'm giving this to your client, $5,000, with no expectation that they ever have to repay me. And then we can use that as well. So on future videos, we're gonna go into kind of down payments that you're gonna see in various products. Remember that Arizona has multiple down payment assistance products that we use a lot to get their down payment to a couple $1,000s all the way to zero if we put together the concessions correctly with the agent. Anyway, so 3 main qualifications: credit, debt to income ratio, and assets is what we're looking at. And on to the next video here shortly, we'll go over some more things. Talk to you soon. Bye-bye.